Hello, thanks for taking the time to watch another one of my videos. Today we're going to look at the question of investment diversification and also take another look at this book, the Daily Telegraph Investor's Handbook Guide to Stocks and Shares, because there's some pertinent gems in this book relevant to our topic, and it's also mildly amusing, taking the mickey out of what people wrote 40 years ago, the world having changed considerably. So, as an introduction, may I firstly ask you to think about why do you want to diversify an investment portfolio? Have a think about that. I would remind everybody who's been through my formal training course of the default example I give based on my being a child of that wonderful seaside resort, Bournemouth. I suggest that somebody, having been fortunate enough to win a concession to operate a small shop near Bournemouth Pier, would have to consider how to stock their shop to maximise their chance of paying the exorbitant rent to the Bournemouth Corporation. And knowing the British weather, as we all do, they probably would not just fill it up with buckets and spades, suntan oil and a few ice cream freezers. They would also sensibly keep a good stock of umbrellas, folding up raincoats, and possibly even board games and some pulp novels. That way they've always got something to sell irrespective of the weather. That's a great example of diversification. You don't know, it's very true with the weather, isn't it? You don't know what the future's going to be, so you give yourself the opportunity to make money whatever that future might be. Now, that's a way of lowering risk. In the case of the shopkeeper, the risk is nobody coming in because they look through the door and see he's only got buckets and spades and suntan lotions when it's tipping down outside. In our case, it's the fact that our investment in a narrow band of assets might fall dramatically, and those assets might be out of fashion for a long time, permanently out of fashion, or even become completely illiquid. So we want to minimize the risk of losing money, human beings being what they are. That's probably the number one priority. But also, in the way I explained already, we want to increase the opportunity of making money. And because we don't have perfect foresight, one way of doing that is to own different assets, so that at some time in the future, one or other of the assets we own will be in favour and will be in the money. There are disadvantages, of course, in that if you have a diversified portfolio, you're going to miss out when some of your assets are out of fashion. Returning to our example of the shopkeeper on Bournemouth Beach, they have to give up some shelf space, some floor space to umbrellas, raincoats, board games and books, to allow themselves the opportunity to sell something when it's raining. But if there's a really long, hot summer, they might wish they'd got another ice cream freezer in because they kept running out of stock and lost out on sales. That's the opportunity cost, as it's called by economists. So we'll look at the methods of diversification in the next part of this little chat, and I'm going to move now to referring to this book. Chapter 2 is called There Are Safer Ways of Investing, and this means safer ways than investing in stocks and shares. The obvious ones are mentioned, like national savings, certificates, premium bonds and so on, bank and building society deposits, something that in those days went by the wonderful name of roll-up funds. These really exist now, but the tax treatment is slightly different. This is collective funds where the fund manager is investing in deposit instruments and the return in total is added to the capital value, what we call accumulation units. Things like the Fidelity Cash Fund, the BlackRock Cash Fund, many of you own those already. Insurance policies, life insurance policies, some of you will have owned life insurance bonds, as they're typically called, and some may still do so. They have certain advantages in terms of the way profits are taxed. They're taxed in the hands of the insurance company, and that generally means less tax than individuals would pay, and the tax can be deferred so the gains can be taken at a time in the future, perhaps when the tax liability is less. They're also a legal instrument that can be assigned to other people, so they're useful for trusts and inheritance tax planning. Gold is mentioned here, and this is where we get one of our little bits of light relief. The section on gold opens. There are 3 standard sizes for gold bars that are traded on the bullion market: 400 ounces, 100 ounces, and 1 kilo. Even with the gold price down below $350 per ounce, note that, you can buy a kilo of gold for £8,000. Now, most of you probably know the current gold price is nearer $3,500 an ounce. In fact, it's been that. It's about $3,300 today. And that means a kilo of gold costs £80,000 now, not $8,000. So between the date this book was published, which was late 1980s, so say 40 years ago, and now, the value of gold has increased tenfold, which is not bad, is it really? It then mentions unit trusts, what we call collective funds, open-ended investment assets, OICs or SICAVs if they're in Europe. The disadvantage at the time was the costs. It points out that if you bought an investment in a unit trust and your advisor was taking a commission, which they wouldn't have had to tell you in those days, you'd have seen a front-end load of 6%. Of course, we don't pay that at all now. We also pay much lower annual management fees thanks to technology and the use of investment trading platforms. Here's where the book goes off the rails somewhat. This author's good, but he does demonstrate a certain naivety. In selecting funds, he says, look for a fund that has done well over 3 and 5 years. Well, that's fair enough. But then he says, a good sound performance, keeping it in the top quarter of shares in its class, is what you should look for. In other words, pick first quartile funds. It shows tangible evidence of a reliable, trustworthy outlook on life that is likely to produce a repeated above average performance in future years. Complete load of tosh. What it shows is that over the last 3 or 5 years, the fund manager made good decisions in the context of the macroeconomic climate prevailing, or was lucky. His investments happen to fit that climate. It does not in any way offer proof that that fund manager will do well in the current macroeconomic climate or indeed the future. You need to know a lot more about how the results were achieved, not what the results were, and that is not pointed out in this article, although in fairness the author, who I generally respect, I should say, suggests writing off, those were the days when they were used to write off to the managers of the unit trust and ask for the copy of their latest report. These days, of course, you just get some stuff from Morningstar or TrustNet or another resource. I like the fact that in talking about shares or collective funds of shares you should avoid, it refers to junk bond shares in tea, rubber and third-rate oil companies. We don't often spend our time talking about investing in rubber companies these days, do we? The book progresses to investment trusts and makes some entirely valid points consistent with what I have said quite a few times, both in person to my subscribers and in this in my website. It starts off, the costs of acquiring these are lower than the costs of buying unit trusts, or so the investment trust managers claim, and indeed many journalists. The claim is something that should be taken with a pinch of salt, because investment trusts are quoted companies listed on the stock exchange. And to buy them, you have to go through a stockbroker, paying both buying and selling commission, stamp duty, and a turn, in other words, a spread, which can be exorbitant in case of the lesser-known investment trusts. It points out that investment trusts can have a far greater proportion of unquoted investments. That really does increase risk because unquoted investments often have low or sometimes no liquidity at all. This extra investment freedom has allowed some trusts to commit monumental mistakes in the past. That's extremely valid point. An investment trust can borrow money to invest in shares, giving an element of gearing that is illegal for a unit trust, open-ended investment company today. It also says that the pricing of investment trusts is subject to market demand, which means that a surplus of sellers and a shortage of buyers can push the purchase price to lower than the net asset value backing. That's the principle of discounts. The calculation of discount raises a serious problem for the private investor. I'm quoting selectively here. Supporters of investment trusts see red in this argument. They point out that it's possible to buy investment trust shares on large discounts and sell them on small ones. So investment trust shares outperform the market. Absolutely true. But it then says this is an area which is best left to the professionals. I would confess that I have recently done that, bought an investment trust, say Polar Capital Technology, when it's out of fashion, on a really big discount, which means maybe towards 20%, and sold it again when the market went up, so the discount narrowed as well as the net asset value going up. But you have to be able to watch the price regularly and to understand what's driving the discount. So not for the average person. It is emphasised in the book, it is important that the investor understands that this investment concerns something more than the rise or fall of the stock market, and for that matter, the quality of the investment management going into the fund. It concerns the level of discount as well. You have to check discount or occasionally premium levels if you're going to buy investment trusts. There's a concluding section of the book called Split Level Investment Trusts, which is something that resulted in a mis-selling scandal in the 1990s. They were a very well thought out device, but unfortunately many of the people buying them had no idea how they worked, and having made major mistakes, then considered it was the fault of their advisors not to properly point out the risks, and indeed in many cases it was, and so compensation had to be paid. Let's now move on, and I'm going to now refocus the camera onto my whiteboard because I want to write down some of the let's zoom in a bit. Some of the answers as we come up with them. You'll see I put a heading on there, diversification. What are the main methods of diversification? Well, I think you probably all know. I'm going to go in and out of a shot here because that's the result of focusing on the whiteboard. Asset class diversification. So that's diversifying by investment type. And the main investment types, I'm not going to write them down because I think everybody should be more than familiar with these. That's equities, fixed income, deposits, cash, as it were, commodities, typically gold, absolute return funds, or specialist diversified investments designed to control risk, commercial or physical real estate or property funds, and arguably some other forms of specialist derivatives. Next way we can diversify is by geography. Clearly, you might expect investments to perform differently because of the different investment climate or different underlying macroeconomic facts applying in different markets. Interestingly, geographical diversification does not diversify risk that much. The systemic risk of a fall in equity share prices will apply throughout the equity market. You can't get away from that risk by owning investments in different markets. I actually checked the current levels of diversification between the main equity markets relative to North America, which is the largest market as we know. Europe is about 75% correlated, the UK about 70% correlated, Asia Pacific 65% correlated, and emerging markets 60% correlated. This is data from Copilot, by the way. And over the last decade, the diversification levels have tended to narrow during crisis. So, for example, during the pandemic, the level of diversification reduced. All equities suffered more or less to the same extent, in that after all it was a genuinely global crisis. Otherwise, ignoring crisis, diversification away from North America has widened slightly. I suspect that's because of what, until Trump, was called American exceptionalism, where the American market did well, whatever. Other markets suffered more ups and downs and possibly more relative downs, and therefore appeared to be less correlated with the US market. We can also diversify by industrial sector. Remember from the book, we can avoid buying tea and rubber companies. Seriously, investment sectors can be subdivided in different ways, and dividing your portfolio in this way will result in some overlaps. In other words, these definitions are not mutually exclusive. So you can diversify, for example, by growth to value. This is a common division of investment assets as analysed by the likes of Morningstar. You can diversify by defensive versus, I would say, aggressive stocks. You can diversify by dividing between cyclical and non-cyclical. What does that mean? Well, cyclical stocks move with the economic cycle. So, for example, consumer cyclical, these are things like travel companies. When the economy is booming, people spend more money on traveling. Therefore, airlines typically do well, and travel retail businesses would do well, and so on. Non-cyclical are, for example, in the retail area, products that you buy whatever, like pharmaceuticals. The fact you're not earning enough in a climate of inflation doesn't stop you buying the important medications you require. Or the health service buy them on your behalf if you happen to live in the UK. High yield versus high growth. By that I mean businesses that pay out their profits in dividends compared to businesses that reinvest them into the expansion of the business or into other businesses. This is interesting because there are cultural differences globally, so geographical diversification sometimes reflects a difference in view. Classically, that was the case until quite recently in Asia, between paying the shareholders, particularly external shareholders who are not your local mates, dividends, and reinvesting in the business of your brother-in-law who's looking for some startup capital. These will overlap in that you could perfectly well buy a growth business that is also non-cyclical. It's unlikely that a growth business would be paying out high dividends, in the growth businesses, almost by definition, don't yet have significant profits or in spare cash flow, and indeed are often burning capital. But you can have overlaps. The last one I would put on the high level division is market cap. Market capitalization. So that's the difference between the very large businesses, take Apple or Microsoft as extremes, businesses that are into the trillions of US dollars by market capitalization, and the smallest listed businesses, which might only be in a few tens of millions. Those businesses will have completely different sorts of operations, and their share prices will perform in a different way. That doesn't really give you much diversification in terms of structural problems. If the UK economy is doing badly, it's quite likely that most UK businesses would do badly. Although you might think, well, hang on a sec, some businesses listed in the UK don't really trade much in the UK. Most of their money comes from overseas, or a lot of it. Businesses like, say, Shell or Unilever. Whereas a small business that manufactures greetings cards and retails them in the UK would certainly suffer in a recession. A cyclical business like that, and it being a small company, it may actually go bust. That introduces the idea that one reason for diversifying by market cap is actually when you want to add risk. Your diversification is to give you more opportunity. Small companies have effectively a geared ratio to very large mega cap companies in terms of volatility. You get more volatility with smaller cap, and you can progress to that through mid cap. Consequently, if you're expecting things to go well, you might want to have a larger exposure to small cap stocks, because that will gear up your returns. That brings me to the last point I want to make in today's talk, which is the use of diversification in a logical way. Saying, well, we've created a perfectly diversified portfolio, we've controlled our risk, balanced out our opportunities, and checked all the numbers, mathematically this is ideal, is in no way the right way to do it. If you think about it, let's give a simple example here. If you bought an investment that went up when economies were growing, and hedged it with an investment that went down when economies were growing, but went up when economies were shrinking, so you've hedged your risk, and you managed to get that perfectly right, over time you'll make no money. The hedge will balance out at all times. So excess diversification that's never changed will actually dilute returns. Tactical diversification is, in my experience and my very strong opinion, much more worthwhile. You need to be able to select your investments so that although you're controlling risk, you have the best exposure to what you think are near-term opportunities. And that, to some extent, is another way of describing a contrarian investor, somebody who says, well, this has just happened that's bad, that means these assets are cheap. I'm going to buy some of them because in time they will go back to fair value. Of course, you have the risk that time might be a little way in the future, and you can only afford to take the risk if you have other defensive assets. And perhaps another form of diversifying, which I haven't actually written on the board, is the idea of having a core portfolio that you don't much play around with, and some satellite investments that are your side bets, or your gambling pot, as the Daily Telegraph book referred to it. If we're going to do all this, how do we know where we've got to so far? Well, there are some useful tools. The most useful, bearing in mind we're talking about asset diversification across asset classes and within equities and within fixed income, are the Morningstar portfolio reports. The highest level report, top section, will tell you how much you've got in equities and fixed income, analysed and drilled down through your funds, not just by fund name. And most usefully, you have the 9-box grid showing equity style between growth, value and blend, and across market capitalisation between mega to large cap, mid cap and small cap. If you get fund fact sheets and you go directly to those fund fact sheets, not through Interactive Investor, you usually can get a 25-box grid, and that also includes, I'll show you that, in the 25 boxes, a shape like this, usually a sort of ellipse, which is the exact exposure of the fund to the various stocks. So in the bottom down here you've got small cap value, for example, and up here you've got large cap growth, and the shape may be somewhat different to what you might expect. Very useful when comparing individual funds. You might have one fund where the shape is really like this. There's a lot of small cap value in there, which the fund title or the fund's objectives may not have told you. Another fund might be like this. It's nearly all mid cap. That gives you an idea of how the fund manager within a fund is diversified. In terms of your portfolio, you'll tend to get shapes. Let me draw this separately. So there's your 9-box grid. And if you've got, you know, the denser colouring looks like that, that's what I'd call a T-shape, obviously. That means you've got a lot of large cap, but it's reasonably well spread across the growth, value, and there's a lot of blend in there. Classically, here's a 9-box grid again, investors will have this, a good spread of their large cap stocks across value, blend and growth, but their market capitalisation is all spread amongst growth stocks. It's quite hard to find small cap value stocks, and indeed they might arguably be the most risky. Anyway, I think that's enough for this presentation. I will happily give more guidance on a one-to-one basis for those who are subscribed to my monthly call service, and I hope also that if you have any comments or questions, you will send them through to me or post comments on the website. Thanks again.